Welcome to ET webinar. I'm your host Pallavi Arun Verma. These are indeed challenging times, not just for India, but for the world economy. As India is under lockdown to prevent further spread of novel coronavirus or COVID-19, Indian stock markets have witnessed one of its steepest falls in the recent times. This has actually led to panic and confusion among investors. To discuss what investors should do in the current market scenario, and to share his insights, we have with us Mr. Sampath Reddy, Chief Investment Officer, Bajaj Allianz Life. Sampath is the key force behind Bajaj Allianz Life Insurance fund performance and has helped strengthen customers' trust in the brand. Sampath leads a strong team of fund managers and works closely with the banking and financial services fraternity in India. I welcome you to this webinar.
Thank you, Pallavi. I hope I'm audible. On behalf of Bajaj Allianz Life Insurance, I welcome you all to this webinar. I know this is a challenging time. I'm sure all of you are staying safe at home. At this point of time, I would like to reach out to you all that how are we seeing the markets? How are your funds with us? Whatever question that you may ask, you may want to ask about investment related issues. I'm happy to help you on this occasion. The way we structured this webinar today is that I will make a small presentation about how the markets are positioned, what's going on in the markets. You see there's a lot of volatility in both equity markets and as well as debt markets. Nowadays yields of in the corporate bond yields are spiking up. Most other companies' share prices are falling substantially. There are lots of lockdown, shutdown related news. We keep hearing that many of the manufacturing companies are shutting down their plants, and all kinds of these news are going on in the market. In this backdrop, I would like to, give a brief presentation as, how we are seeing the markets. Hopefully that will help you to deal with your investment decisions. And after this presentation, I will also take few question and answers which have come to us.
Sure. As we begin the presentation, I would like to take your opening remarks on the different steps which the government has taken. We'll move on to the presentation, but just your opening remarks about what RBI has done and the relief packages which have been announced by the finance minister this week itself.
Yeah. Okay, I will be talking that I will be covering that as well in my presentation. There has been fiscal stimulus announced by the finance minister some time back, and yesterday we had seen RBI coming out in its monetary policy with a whole host of measures addressing most of the market related concerns. I will be covering that in my presentation as well. Just to begin with what's going on in the economy. The impact of the COVID-19. Initially we all felt across the globe. We felt that most of the markets believed that in the early Feb it was in a phenomenon only restricted to the China. We all thought that it would not really. Nobody anticipated that it will become such a widespread the disease such a short span of time. As we speak now, most of the countries across the globe are suffering from this coronavirus issue. As we speak, most of the countries are not only India, most of the countries across the globe are following a severe shutdown or a lockdown. This is actually leading to a huge amount of demand destruction across the globe. Most of the manufacturing companies and even services companies are also shutting shop and are advising people to stay at home. All of these are actually leading to the huge demand destruction. As you would have seen that not only what it started off in China, it has become a widespread disease in the US, Italy, and Spain, and most of the European countries are suffering from the same issues. And similarly, we are also facing the lockdown because of this particular issue. So overall, because of this lockdown and shutdown, most of the leading economists are predicting that the GDP growth will come down substantially. As we see it in India, how we see it, how is it affecting in Indian market? If you recall that for the last few quarters, India was already facing a substantial slowdown. Last few quarters, GDP growth was very weak. we've been just growing about, GDP was growing at about sub 5% for the last few quarters. We were already witnessing a slowdown, but with the various measures taken by the government in the last budget, and prior to that, the corporate tax cut, stimulus, and all of these things taken together, we were all anticipating that the GDP will recover in the month of in the FY21. That and from about 5% GDP growth, we were looking at the GDP to accelerate about 6% in the FY21. But due to this shutdown and the lockdown, as we see many companies across India, across the sectors, have shut down the shop. Because of this, we've actually the GDP could come down substantially. Probably come up instead of earlier expectation about 6% growth in the FY21. This could probably come down to 2 to 3% in FY21. Not only does GDP growth coming down, but it will also have a significant impact on the corporate earnings growth as well. Corporate earnings growth, which was anemic for the last 4 or 5 years, was expected to recover very well in the FY21, but I think that also will get punctured big time, because of this particular issue. Due to all of these things are actually led to the extreme fear in the market because of the lockdown and shutdown. All of these things have led to the extreme fear in the market. The Nifty has corrected almost about 39% from its peak. As we speak, the valuations have now come to about 12 times earnings multiple. But the intrinsic value of the companies, continues to be, stay high, stay good. The intrinsic value of the companies do not change, much by just near-term impact of the earnings. Maybe 6 months earnings or 1 year earnings, do not, dent the earnings so much. As we see that, as the lockdown and shutdown has become, global phenomenon now, most of the countries and central bankers, are coming together in a coordinated manner to fight this, the coronavirus. If you look at the U.S. market, the U.S. Fed has cut the rates twice. One in the 4th March they've cut about the 50 bips, and again on the 15th March, again 100 bips rate cut has taken place. In India also, the RBI has cut the rates by about 75 basis points, just yesterday. And also the UK and Russia and across the globe, Brazil, most of the countries have reduced the interest rate, and also have come out with a very good fiscal stimulus policies as well. Similarly, India also, we have, other day, last week, we have seen that, finance minister announcing a very big fiscal stimulus up to 1.7 lakh crores worth of rupees. They're spending this much money on the economy. A lot of people may be arguing at this stage that most of the spending, most of the fiscal stimulus announced by the finance minister is actually nothing related to the capital markets per se. It is true, at this juncture, the fiscal stimulus, it should be targeted mainly, protecting the people, mainly towards, supplying the basic essential towards the poor people. Even if the fiscal stimulus per se, were targeted towards the capital markets, or stimulating the demand, that would not be of much of a help at this juncture. As we're currently going through the lockdown and shutdown, any fiscal stimulus towards the corporate sector today at this juncture, may not be meaningful. I'm sure, once we come out of this lockdown and shutdown, there will be a further fiscal stimulus, to kickstart the demand, but that will be a later stage. The first leg of the fiscal stimulus, should be targeted at, protecting the, health and wellness of the people. I think that's what, the government has done. And not only that, this US at this juncture, has expanded the balance sheet in a significant way. They have also announced about $2 trillion worth of stimulus. And as we speak, the Fed has crossed its balance sheet by about $5 trillion, which was about $4 trillion sometime back. And the expectation is that the Fed balance sheet might even go touch $10 trillion in a year's time, which means the Fed is now this time targeting announced pretty much like an unlimited kind of a stimulus. In the past stimulus, like with the GFC, global financial crisis, at that point of time, they have said that stimulus was a quantitative easing was for a defined amount, maybe $500 billion or $800 billion kind of an amount. This time the Fed has said that pretty much the quantitative easing will be pretty much unlimited, and not only that, they are also actually using the stimulus to buy the corporate bonds as well. So in order to provide the liquidity. So across the globe, governments and the central bankers are taking substantial amount of steps to to fight this the COVID related impact of slowdown. In India also, RBI has yesterday has come out with a monetary policy, monetary stimulus, and I would say that RBI has done pretty much everything that the market was hoping to do. One is they have reduced the repo rates by 75 basis points, and also the cut the CRR cash reserve requirement by 1%. This will help the banks to reduce the cost of funds, and at the same time injects about 1.4 trillion rupees of liquidity into the market. And also, given that during this period, it will be very difficult for most of the lenders like banks and NBFCs, microfinance companies to collect the money. It's quite difficult, and because of this lockdown and shutdown period. Because of that, keeping these things in mind, RBI said that there is a 3 months moratorium on any loan-related payments. This is again in a very good step. This helps the banks and financial institutions to manage their NPAs better. That's again in a positive development. Not only that, another the targeted LTRO, which was long-term repo operations. That particular one, with a amount of 1 trillion rupees is targeted towards basically the borrowings under this program is should be used for purchasing the corporate bonds and commercial papers of investment grade. Now, what this means is that in the bond market there was an extreme fear. There were no buyers for even high quality corporate bonds. To address this fear, to inject the liquidity into this corporate bond market, the RBI has come out with a targeted LTRO with a 1 trillion rupees. Immediately we had seen the impact of this on the market. So overall, I would say yesterday's monetary stimulus, in that RBI pretty much addressed everything that the market wanted, what market was hoping from the RBI. As we see in the next slide, RBI is been maintaining a very good amount of liquidity in the system. Currently, the liquidity is about 3 trillion rupees in the system, 3 lakh crores of rupees. The banks are sitting with such kind of a surplus money to the tune of about 3 lakh crores of rupees. The RBI has been ensuring that there's a good amount of liquidity through its LTRO and OMO operations. As we have seen, usually the corporate bond, trade about 80 to 100 basis points premium. I'm saying the AAA corporate, highest quality corporate bond paper, trades about 180 to 100 basis points over the government bond yields. Prior to the yesterday's RBI policy announcement, the yields was almost, as high as 152. The difference in the premium was almost about 150 to 200 basis points. Immediately after the policy announcement, they have come down. As we would think that because of these measures, it will the corporate bond market will also normalize very soon. Because as we've already been going through a little bit of a slowdown in the past few quarters, interest rates have been coming down. RBI has been proactively bringing the rates in the system, and because of these particular the lockdown shutdown related slowdown, we believe that interest rates will have a substantial downward bias from even from now here till we really come out of this this slowdown. This is again another style. The equity market was, and both the equity market and debt market seen a significant sell-off from the foreign institutional investors. As we see that most of the developed market, U.S. and European market, are facing substantial slowdown because of the the COVID issues, and that has caused a significant risk off in the capital markets. Just in the month of March alone, FI sold about 60,000 crore worth of stock in the month of March alone. Just to put this in the context, whole of last calendar year 2019, FIs have put in Indian equity markets about 1 lakh crores of rupees. Just in the month of March alone, they sold 60,000 crores. That's the kind of the impact, selling impact we had seen in the last month of March, and even in the debt market also, just in the month of March alone, FIX have sold about 52,000 crore worth of stock, and similarly, whole of the calendar year 2019, FIX have brought in about 26,000 crores. Just to see how big is the sell, 59,000, 60,000 crores in the equity and 51,000 crores in the debt market. There's a large amount, but this is something like in the debt market. It's like whole of last year's inflows, twice the amount of whole of the last year's inflows is actually we had seen that much of amount seen in the just 1 month as an outflow. And so because of this, there has both debt and equities together, we have lost about 1 lakh crores. Which means FIs have taken away about 1 lakh crores of rupees of money in the month of March alone. That had put a bit of pressure on the rupee. We have seen that rupee depreciated in the last 3-4 weeks. But what I would like to say is that India is very well prepared to face this kind of the shocks at this juncture. Today India is sitting on a huge amount of forex reserves, upwards of about $480 billion, which can cover more than 12 months of our imports. Unlike in the past, this is unlike in the past. Let's say in 2013, when the FIs were selling off, during that point of time, our FX reserves were not that high. So today we are sitting in a very good amount of foreign currency reserves. We can easily withstand this kind of an outflow. And not only that, the crude prices are also at substantially low. So India's external position to this kind of any eventuality where if the slowdown continues for a longer period of time as well, we can easily match most of our the redemption capital redemptions. Just to see these things, how serious, how big the market fall was. In the last 2 months alone, from the peak to the trough, market fell about 39%. Just that is in a short span of 63 days. If you look back in the past corrections, let's say in 1998, when the Asian markets were falling, during that time, Indian markets have corrected about 40% from the peak to the trough. But that took almost little over 1 year's time for that level of correction to take place. And similarly, during 2001, during the dot-com bubble, Indian markets have fallen by about 58% from the peak to trough. But again, that is also almost took about 2 years of time. And in 2008, in the GFC crisis, global financial crisis, at that time, market fell from the peak to trough about 64%. That also took almost about a year's time. But this fall of 40% has just happened so swiftly in just in the span of just 2 months. Now, we must all notice that the equity the equity market values is a function of equity share price is actually a function of the long-term earnings potential of the company. So the intrinsic value of the company really does not change so much, for a lockdown or a shutdown for let's say about 2 to 3 months period. Yes, we do agree that the shutdown is going to have a severe impact on Indian GDP. Is going to have a severe impact on the corporate earnings. But maybe for about 2 quarters or even 3 quarters, even it may last for a 1 year period. 1 year, maybe even FY21 earnings could be pretty much zero or negative. even if that were to be the case, the intrinsic value of the companies really do not change much. Once we come out of the shutdown and lockdown period, once things come back to the normalcy, we would see a equity market will be higher than what it is today.
Sure.
Coming to the next slide, we are not saying that earnings are not getting affected. Earnings, this is a severe slowdown. Most companies across the manufacturing sector are facing shutdown. Companies are not able to move the goods. This is going to wash out the earnings for the next couple of quarters. Share prices have already fallen substantially. As I said, the intrinsic value of the company is a function of the long-term earnings growth potential. That won't change much by an impact in the couple of quarters of earnings alone. Maybe 1 year, 2 years of earnings, will probably need to will dent the intrinsic value by about 5-6%. But the market has seen substantial amount of correction and a bit
Right.
of this. People may say, one may say that, what I would like to say that this may not be the best time to invest, but certainly it is an excellent time to invest. What I'm trying to say is that equity values have come into a lot of stocks across the board trading way below their intrinsic values, they're attractively priced. It is possible in the next couple of months, the way the severity of the COVID issue pans out, we may see some more downside. That could be the best time to buy. But I don't know whether we will be really able to catch the real bottom, which is the best time to buy. But given the way the valuations are, given the way the stock prices have corrected, this is excellent time to stay invested. And at this juncture, I would like to reassure you all that we at Bajaj Allianz Life Insurance are maintaining a good amount of liquidity across our portfolios, and we as a team are working smoothly from the home. We're all staying at home, and investment operations are continuing pretty much, I would say, smoothly without any issue. We are monitoring the portfolios daily and taking appropriate action while working from home. At this juncture, I would like to wish you all that stay safe at home. That's the best thing to do at this point in time. With this, I would stop with my opening remarks, and maybe will take up any questions that you may have.
Sure. We've received a lot of questions and we've tried to club some of them since some of the questions were quite similar. So I begin with the first question, which was the most asked question about COVID-19 and the lockdown blues. So the question to you is, how much time will it take for the economy to recover from the COVID-19 or lockdown concerns that we have? And are there factors apart from COVID, which you have also mentioned during your presentation, that are going to impact the economy in the near future?
Right. Yeah, it is. It is very difficult to say how long it will take. About if you asked about people, most of the people at about a month back, was anybody envisaging this level of shutdown or lockdown? Nobody would have said that it would be. Nobody would have predicted this. And
Right.
all I can say is that people are now having seen the impact in other countries. People are expecting that this 21 days may even continue a little longer. Maybe it could continue for a couple of months more. I think markets preparing for that kind of eventuality as well. Whether it is a 1 month or a 21 days, a 1 month or a 2 months or a 3 month, the underlying intrinsic value of the businesses won't change so much. If we were to believe that 6 months down the line or sometime in the future we will overcome this issue. If that were to happen, I think equity markets will rebound soon.
Right. So moving on to the next question, should we stop premiums? A lot of people are concerned whether they should stop their SIPs, whether they should stop paying their monthly premiums. So one of the viewers have asked is that should we stop premiums currently, as in the last few years, regular mode investments are giving all negative returns. What is your say on?
Yeah, yes, it is true that most of the investors may not be making any returns, and actually most investors facing a huge negative returns. People especially who have even invested in the last 3 to 5 years as well. Yes, I do agree, and a 3 to 5 year basis also having negative returns is not a great thing. Is not a good thing. But what I would like to say that these are unprecedented times. Market, there's an extreme fear in the market. The stock prices are trading way below their intrinsic values. I mean, we believe that once this COVID issue gets sorted out, the markets will rebound. Stock prices will be way higher than what they are today. I don't think this is the time to even stop the investment or redeem from the market. I mean, it is the time actually to stay invested, or rather add to your investment. But if you go back and see in the history, anytime in the investors who made investment during the very challenging times like this, those are the ones who made the best returns. I would recommend to stay invested, not to exit.
In fact, there's a question which is about fresh investments. You say that people are already invested; they should stay invested. But one of our viewers wants to know whether it's a good time to enter the equity markets, or there could be further correction, as we've discussed during the presentation as well.
Yeah, as I said, like all of us would like to catch the bottom. When the market is at its last its lowest point, that is when you would like to invest. But it is very difficult to figure out when is the bottom. So do not try to catch the bottom. It is very difficult, almost impossible. If at all you happen to get there, it's pure the sheer coincidence. So all I would like to say is that this may not be the bottom, but this is an excellent time to invest. Value share prices across the board are trading way below their intrinsic value. This is one of the
Sure.
best time to invest.
Right. So this is, in fact, an opportunity. Investors should look at the dip as an opportunity to start investing. The next question that we've received is regarding the funds of Bajaj Allianz, and one wants to know that how they performed in the current scenario and which sector could be good to enter at this stage. If you can give some recommendations.
So we have a gamut of funds at the Bajaj Allianz Life Insurance. We offer both the traditional endowment funds, which are participating fund and non-participating fund. Participating fund predominantly invests in government bond, which gives a steady return, and also the non-par funds offers pretty much like guaranteed returns. And we also have we also have unit linked funds. Again, within the unit linked funds, in a gamut of investment styles like large cap equity fund, mid cap equity fund, flexi cap, and the bond fund and liquid fund. So entire gamut of investment styles that are available. We pretty much offers to under our Bajaj Allianz Life Insurance products. So customers should choose whatever is appropriate for them. As far as at this juncture, equity funds generally have not been performing well even in a 3 year or a 5 year perspective. Most of the funds are probably could be giving a very meager returns. But as I said, these are extraordinary times. Share prices are trading way below their intrinsic value. Once we come out of this, the slowdown related issue, I think investment returns across the unit linked funds also will rebound. Investors who are concerned about market volatility, can look at participating fund or non-participating funds as well.
Right. Right. The next question is about some of the life funds but we've already taken up this one, so we'll move on to the next one. Should we shift to debt funds at this stage? A couple of our readers they wanted to know this. One of them has sent this question: should we be shifting to debt funds, and should we wait for some more time?
So, debt funds have done very well as the interest rates have come down in the last 1.5 years. Debt funds have done very well, almost given a double-digit returns in the last 1 year perspective. And as I mentioned in my presentation, that we still think that interest rates have a downward bias, which means debt funds will continue to give a good returns. But should one shift from debt to equity or equity to debt, this kind of an issue? I mean, this is something which investors should look at based on their needs and risk appetite, and they have to decide their allocation in consultation with the financial expert. We at the Bajaj Allianz, our life insurance offer entire gamut of investments, whether debt,
Right.
equity, and funds. The customers, we try to manage, all of these funds based on the investment objective, based on the risk return expectation from each of these funds. I would say, for me as a CIO, all funds are equally good, equally important. It's you are the customer based on your risk appetite. You have to choose what suits you the best based on your needs.
All right. The next question is on mutual funds. Currently, I'm investing small cap fund via SIP, and should I invest lump sum, keeping in view a timeline of 5 years? What do you have to say on this?
Yeah, I think the small cap and mid cap funds also beaten down substantially. They are also trading way below the way below the fair value. They are also trading at a very attractive valuation. I mean, the way I would like to say is that typically in a downfall like this, turbulent times, challenging times like this, mid caps would have corrected even relatively more than that of the large cap funds. But in the recovery, most likely the first leg of recovery will take place in the larger cap funds and then followed with the small cap and mid cap. But I would like to say that small cap and mid cap are also very attractively priced.
All right. So mid caps and small caps both are attractively priced according to the expert. We have some more questions, and we'll be taking up some more as time allows us. Next question is what opportunity the current crisis gives us, and what do we need in case of more falls? So again, people are concerned whether there'll be further more correction. You already mentioned we shouldn't be timing the market as of now, but this is the tendency of every investor, and we can't really deny this.
Yeah, it is true. I think one should not see, like if one was investing into the equity markets all these last few years, when the markets were Sensex was at 40,000 and Nifty was over 10, 11, 12,000. Absolutely there is no case for the investors to run away at this juncture. The businesses are real, companies are real. All you need to do is that choose good companies and stay invested with them over a long period of time. Investors would certainly make good returns from the markets.
Okay. All right. Besides the investors, one of financial advisors have asked us a question, and he wants to know, as a financial advisor, what should be our recommendation to the clients on new investments and funds, especially in the next 3 months. So, as you mentioned, that this whole lockdown scenario may go on for the next couple of months. So, how do you see the entire investment scene in the next 3 months?
Yeah, I mean, we are going to face a substantial slowdown because of this lockdown, and most companies, are not even manufacturing anything, and on top of it, there will be bogged down with a lot of fixed costs related to the rentals and interest costs and salaries and wages. All of this is going to have a significant negative operating leverage on the company's P&L, which will show up in the next couple of quarters. Yes, the earnings are going to be very badly affected across most companies. In spite of all this, once the lockdown shutdown gets removed, once the business comes to normalcy, it won't take much time for the companies to regain regain the good profitability. So I think that's why one should stay invested. Use this opportunity to add more based on the risk appetite to the equities.
Sure. Moving on to our next question, please elaborate on the pure stock fund. And in fact, some of the funds is mentioned accelerator mid-cap fund performance in the last 3 to 5 years. So maybe he wants to know how has the fund performed so far.
Yeah. So our funds, both pure stock fund is largely the flexi cap fund and accelerated mid cap fund targets invest in the mid and smaller cap companies. In line with the benchmarks, in line with the performance of these two funds are also been in line with the benchmarks. As I mentioned, the equity returns of both large cap as well as flexi cap and even mid cap funds in the last few months have not been very encouraging because of the recent fall that we had seen. But we have been these funds, pure stock funds and large cap fund and mid cap funds of Bajaj Allianz Life Insurance have been rated pretty well and have been generating very good competitive returns vis-a-vis the benchmarks and the peer group. I would think that once these issues get sorted out, investors would see a very good spike in their NAVs.
Absolutely. So, moving on to the next question, please give us your view on a fund with a mix of 80% debt and 20% equity for a horizon or perspective of 1 to 3 years. So, in the next 1 to 3 years, if somebody is investing in a fund which has more of a debt portion and less of equity, what can you suggest for him?
So we do have the funds which are targeted at a different debt and equity proportion, which in our balance fund, asset allocation fund. That is also very good platform for investors who are a little bit worried more about the volatility in the equity market. Investors with those kind of worries could look at the balance fund with in which substantial portion of money invested in the debt and some portion of the money invested in equity for a kicker. Those funds also, and over the long term, could do slightly better than the pure fixed income, assuming that equity will generate, the better returns over the debt funds.
Surely. So we now move on to the last question for the day. The question is, which is an ideal fund option for the next 1 to 2 years if the amount is 50% large cap, mid cap, and 50% bond fund or ULIP? Ravi is asking the different categories, different assets where he can invest, and a comment on ULIPs as well. At this point in time, do ULIPs make a good, attractive investment option according to you?
Yeah, yes, ULIPs do make a good investment option. We at Bajaj Allianz Life Insurance under our ULIP platform offer entire gamut of investments, as I said, large cap fund, mid cap fund, and the balanced fund, and the bond fund and liquid fund. Investors can choose any of the investment style that they like. Usually during the market peaks, when the equity valuations are overheated, investors usually prefer to stay invested in the debt market, and vice versa. These are the times where equity valuations are way below the fair values and intrinsic values, and probably I would think that the investors should the relative attractiveness of the equities is far better at this juncture. So, but as I said, we at Bajaj Allianz Life Insurance offer entire gamut of investment fund. Even not only the unit funds, investors who do not, want the volatilities of this market-related volatility, they can choose to invest, save or invest with us in a participating fund, which largely invests in the government bonds and corporate bonds and some amount of equity. And also, we offer non-participating savings under the non-participating product. There we offer a fixed return guarantee to the investors. So investors can choose the entire gamut of investment styles, based on the risk return appetite. From my perspective as the investment head, for us, all funds are equally good, and I would say all funds are managed based on each one of its individual investment objective. So customer who can choose, should choose whatever is best suited for them.
Sure, sure. So with this, we come to the end of the session. But before we let you go, one last comment from you. As we could see from most of the questions, people are concerned about the immediate scenario. Maybe 3 months, somebody wanted to know about the 1 to 2 years time. But according to you, would it be correct to say that investments made in such a bull market or such a situation, they are bound to provide better returns in the longer term? What is your perspective on this and your closing remarks?
Absolutely. The investments made in challenging times like this, are generally rewarded the best. With that comment, I would like to say that this is one of the best time to invest. It's an excellent time to invest for sure. Not the best, I don't know when the bottom is going to be in the next 1 2 months, but it is certainly an excellent time to invest. Investors who made this investment in challenging times in the historically ended up having the best returns. So at this
All right.
at this juncture, so I would like to thank you, Pallavi, for having this webinar, and also I wish all our customers and distributors to stay safe at home, and thank you very much for your interest and participation.
Thank you so much for taking time on a Saturday for this interesting and very informative webinar. And thanks to all the audiences and viewers who've been watching this webinar. And stay tuned for more updates and more information on your investments and everything that matters to you. Thank you so much, sir. Thank you for joining.
Thank you.